What you are about to see is not a market correction. It is not a routine fluctuation. It is a mathematical impossibility colliding with a financial lie. Friday night. The markets were closed. The trading desks were dark. The world was distracted. That is exactly when they pulled the emergency brake. The Shanghai Futures Exchange, the beating heart of the world's physical silver market, didn't just change the rules. They screamed for help. They hiked margin requirements to levels we haven't seen in modern history. And they didn't do it once. They didn't do it twice. This was the sixth time in a single year. Think about that. If your bank changed the terms of your mortgage 6 times in 12 months, would you think they were managing risk? Or would you realize they were insolvent? Most people are looking at the price on the screen. They see a number. They see a chart. They are missing the avalanche entirely. By the time this video ends, you will understand why the price you see on your phone is a fiction, a ghost of a system that died over the weekend. You will understand why the physical vaults in Shanghai have been drained by nearly 80% in just 4 years. And you will understand why what is happening right now in China is the first domino in a global settlement failure that will wipe out trillions in paper wealth while leaving the physical holders standing on top of the rubble. We are witnessing the end of the paper suppression era. The physics of supply and demand are finally crushing the paper markets. But there is a specific reason this is happening right now, a trigger event that nobody is talking about. And if you don't understand this trigger, you're going to be on the wrong side of history when the vaults officially run dry. Let's step into the darkness and look at the ledgers. To understand the magnitude of this panic, you have to understand the mechanism they are using to try and stop it. It's called a margin hike. In the world of futures trading, you don't buy the metal, you bet on the price. You put down a deposit, that's the margin, to control a massive amount of silver. Usually, that deposit is small, 5%, 10%. It's the grease that keeps the casino wheel spinning. It allows speculators to gamble with leverage. But last weekend, Shanghai hiked that requirement to 19%. For a speculator, this is a death sentence. It demands nearly 1/5 of the contract value in cash upfront. It destroys leverage. It forces liquidation. It is a blunt instrument designed to smash the price down by forcing traders to sell. It is a desperate attempt to cool a market that is overheating. But here is the terrifying reality. They were already at 16%. They raised it to 17%, then 19%. They are ratcheting the screws tighter and tighter, and yet, the price keeps rising. Does that sound familiar? We have seen this before. We saw it in the nickel market when the London Metal Exchange had to cancel trades to save a Chinese tycoon. We saw it in 1980 when they changed the rules to break the Hunt brothers. Whenever the physical reality threatens to bankrupt the exchange, they change the rules. But this time is different. In 1980, the Hunt brothers were speculators. Today, the buyers aren't speculators. They are factories. They are national strategic reserves. They are solar panel manufacturers who cannot produce a single unit without this metal. You can force a speculator to sell by raising margins. You cannot force a factory to stop buying. They need the metal to survive. And this is the fundamental fracture that Shanghai just exposed. The exchange is terrified. Exchanges only move this fast, this aggressively, under the cover of darkness, when they are staring into the abyss. They know what the public doesn't know yet. The metal isn't there. Let's look at the numbers that are causing this panic. The Shanghai Futures Exchange tracks its inventory in warehouses. It's a public ledger, if you know where to look. In January 2021, those warehouses held 3,910 tons of silver. It was a mountain of metal. It looked invincible. Today, that number has collapsed to roughly 820 tons. That is a 79% decline. The inventory has been vaporized. It has been drawn down, melted, and shipped out to industrial zones across China. We are currently sitting at barely a quarter of the levels we saw just 4 years ago. And while the inventory is disappearing, the trading volume, the number of people betting on silver, has hit its highest level since May 2024. Do the math. The paper claims are exploding upwards. The physical backing is crashing downwards. This is the definition of a squeeze. This is a run on the bank, but instead of cash, the depositors want silver bars. And the bank is realizing the vault is empty. But why now? Why is the drain accelerating? This brings us to the Shanghai Signal. You need to understand that there are 2 silver markets in this world. There is the COMEX in New York, and there is the Shanghai Futures Exchange in China. For decades, New York was the king. The COMEX is a paper market. It is a casino where banks trade contracts back and forth, settling in cash, never touching a single ounce of metal. It is a price discovery mechanism that is fundamentally detached from reality. It determines the global price based on bets, not on delivery. Shanghai is different. Shanghai is the factory floor. China is the world's largest consumer of silver. They don't buy contracts to speculate. They buy contracts to take delivery. They need the metal for the 200 gigawatts of solar capacity they are building this year alone. They need it for the millions of electric vehicles rolling off the assembly lines. When you have one market trading paper and another market demanding physical, eventually, they break apart. And that break is happening right now. Here is the piece of the puzzle that the financial analysts on TV keep missing. They assume that if the price goes up, demand will go down. That is Econ 101. But silver defies Econ 101 because the demand is inelastic. Let's talk about the thrifting limit. For the last decade, solar manufacturers have been efficient. They use technology to reduce the amount of silver paste needed on each photovoltaic cell. They thrifted the silver away to save money. But they have hit a wall. In fact, the technology has reversed. The new generation of solar panels, Topkin and HJT cells, are more efficient at capturing sunlight, but they require more silver, not less. Some estimates suggest these new cells use 50% more silver than the old PERC technology. So, precisely at the moment supply is breaking, the industrial requirement per unit is increasing. A solar manufacturer cannot substitute silver. Nothing else conducts electricity as efficiently. If they switch to copper, the panel loses efficiency, degrades faster, and fails to meet warranty standards. They are trapped. If silver is $30, they buy. If silver is $100, they buy. Because silver is a tiny fraction of the total cost of the panel, but it is the one component that makes the whole thing work. This is why the Shanghai margin hikes are futile. They are trying to scare away speculators, but the people draining the vaults aren't speculating. They are manufacturing. And you cannot margin call a production line. The price of silver in Shanghai has been trading at a massive premium over the price in New York and London. We are seeing premiums of $8 per ounce or more. Think about what that means. It means an arbitrage opportunity exists. A trader could buy silver in London, fly it to Shanghai, and sell it for an instant profit. In a healthy market, traders would do this until the price is equalized. But the prices aren't equalizing. The spread is widening. Why? Because you can't get the silver out of London fast enough. Reports are surfacing that London vaults are running on fumes. The metal is being drained from the West to feed the insatiable hunger of the East. The arbitrage isn't closing because the physical logistical chain is breaking down. We are running out of available, deliverable bars. And this creates a phenomenon known as backwardation. This is a technical term, but you need to understand it because it is the death knell of a commodity exchange. Normally, the future price of silver should be higher than the spot price today because you have to pay for storage and insurance. But right now, we are seeing signs of the opposite. People are willing to pay more for metal right now than for metal next month. Why? Because they don't trust that the metal will be there next month. Backwardation is the market screaming that there is an immediate, critical shortage of physical collateral. It is the ultimate sign of distrust in the future delivery mechanism. Does this sound familiar? We saw the same thing happen with palladium before it went parabolic. We saw it with rhodium. When the industrial supply chain realizes there is a shortage, they don't buy less, they buy more. They panic hoard. Apple, Tesla, Samsung, they don't care about the spot price. They care about their production lines shutting down. They are front-running the shortage, exacerbating the very crisis they are trying to avoid. And where is the new supply? The skeptics will tell you, high prices cure high prices. Miners will just dig more. That is the lie that keeps the paper game going. But the geology tells a different story. Silver mining is in a structural decline. Most silver isn't even mined on purpose. 70% of it comes as a byproduct of mining zinc, lead, and copper. That means silver supply is dependent on the demand for base metals. If the global economy slows down and demand for lead drops, silver production drops with it, even if silver prices are skyrocketing. Furthermore, the grades are falling. We have mined all the easy silver. We are digging deeper, moving more earth, and getting less metal for every ton of rock crushed. And you cannot just flip a switch. It takes 10 to 15 years to bring a new silver project from discovery to production. Permits, environmental studies, infrastructure build-outs. It is a decade-long process. So, if demand is rising exponentially due to the green energy transition, and supply is flat or falling, and the stockpiles are empty, what happens to the price? It doesn't just go up. It goes vertical. We are staring at a repricing event. This is what happens when a manipulated asset class breaks free from its chains. The paper market, the COMEX, has suppressed the price of silver for decades by selling infinite paper supply. But you cannot suppress the price when the physical cupboards are bare. The Shanghai margin hike is the signal that the suppression mechanism is broken. They can no longer control the beast. Let's play out the scenario of what happens next, because this is where it gets dangerous for the unprepared. In the short term, expect volatility. Violent volatility. The margin hikes will force some speculators to sell. We might see the paper price dip. We might see a smash. The establishment will try to paint a picture of a crashing market. They will say the bubble has burst. Do not be fooled. While the paper price might dip on the charts, watch the premiums. Watch what you have to pay to get actual metal in your hand. If the spot price drops to $50, but the dealers are charging $70, that tells you the spot price is irrelevant. We are moving toward a bifurcated market. A market where there is a paper price for the gamblers and a physical price for the owners. And the gap between those two prices is where the entire financial system is at risk. If a significant number of contract holders on the COMEX stand for delivery, if they say, "I don't want cash settlement, I want my bars," the COMEX will default. They will have to declare force majeure. Force majeure. Remember that term. It is the legal escape hatch. It allows the exchange to say, "Due to unforeseen circumstances, we cannot deliver the metal. Here is a check for the cash equivalent." Imagine holding a contract for silver because you wanted to protect your wealth against inflation, only to be handed a check for fiat currency that is losing value every day. That is the trap. That is the rug pull. This would be the end of confidence in the precious metals derivatives market. It would be a historic transfer of wealth from those who hold paper promises to those who hold physical reality. And it's already starting. Look at the flow of metal. It is moving from west to east. It is moving from weak hands to strong hands. It is moving from the public exchanges to private vaults. The smart money saw this coming years ago. They saw the deficits. They saw the solar expansion. They saw the EV mandates. They did the math. Now, the math is becoming reality. But there is one more twist. One final piece of the puzzle that makes this situation explosive. The United States government recently designated silver as a critical mineral. After ignoring it for decades, they suddenly realized that their entire high-tech military and energy infrastructure depends on a metal they do not produce enough of. Tomahawk missiles rely on silver. Satellites rely on silver. The entire grid relies on silver. When a government designates something as critical, it is usually a precursor to intervention. We could see export bans. We could see nationalization of supply. We could see price controls. Imagine a scenario where the U.S. government forbids the export of silver bars because they are needed for national security. Overnight, the global market fractures. The arbitrage closes. The metal trapped in the U.S. stays in the U.S. The metal in China stays in China. And the price discovery mechanism completely shatters. This is why Shanghai is panicking. They know that if the music stops, there aren't enough chairs. And they are trying to kick people off the dance floor before the silence hits. The 19% margin is not a rule. It is a barrier. It is a wall they are building to protect the remaining inventory. But walls do not stop hunger. And the hunger of the industrial complex for silver is insatiable. You have to ask yourself, if the people running the exchange are panicked enough to hike margins 6 times in a year, what do they know that you don't? They know that the days of cheap silver are over. They know that the 45-year record high wasn't a ceiling, it was a launch pad. They know that once the 820 tons are gone, the price is no longer determined by traders in suits. It is determined by the highest bidder in a desperate auction for survival. This is a historic breaking point. We are watching the failure of a fiat-based pricing system for a strategic real asset. So what do? You look at the data. You ignore the noise. You ignore the sudden drops in paper price that don't match the physical reality. You understand that volatility is the price of admission for the greatest wealth transfer of our lifetime. The Shanghai Futures Exchange has shown its hand. They are out of ammo. They are raising the walls because the fortress is empty. The paper market is screaming. The physical market is disappearing. The loop is closing. The question I asked at the beginning was simple. Why is the price you see a lie? Now you know. The price on the screen is the price of a promise. The price of the metal is the price of truth. And the truth is becoming very, very expensive. The window to position yourself is closing. Not in years, but potentially in weeks. The next time Shanghai makes an announcement, it might not be a margin hike. It might be a delivery default. And by then, it will be too late. Stay focused. Watch the premiums. Watch the inventory levels. The battle for silver isn't coming. It's here. And the panic in Shanghai is just the opening shot.